Just a quick note, if you are interested in purchasing this indicator in return for you taking your time for watching this video, you can send us an email at daytradinggps@gmail.com to request a discount promo code to purchase the indicator. Thank you. Okay, just a quick note before we start this video. This is going to be a condensed version. Today it's going to be a lot shorter than our typical SPX video. So if you look in the description of this video, you'll see these various links. One is a video overview of the indicator. One is new features video for the new V3.0 version that came out, so you can see what new features were added. There's also additional resources. There's a Google Drive link for descriptions and links to other videos that are about different topics about using this indicator. There's also a link to longer SPX trading videos that go into more detail about this indicator and the daily key levels trading strategy and what all the different levels mean that the indicator gives you, etc. And you'll also see under that there's one particular video that also, in addition to the daily key levels trading strategy, also goes into the SPX lotto options strategy as well. And then below that, additional videos that are just on the daily key levels SPX options trading strategy. Thank you. Hello, in today's video, we'll be taking a look at the Friday, March 13, 2026 trading session for the CBOE SPX index. We'll be utilizing the day trading GPS SPX daily key levels indicator, specifically the V3.0 version of this indicator, which was just released a few weeks ago. Okay, so today's video is going to be a condensed version where we're just going to run through the different trades. We're going to start off with a general overview here, and then we are going to look at a different screen that's going to have the data boxes for all the strikes for the two different trades that were done today. So in today's session, there were two trades. They were both bearish trades. The first trade here was a bearish trade number one, which is signaled here by this 9:30 a.m. opening candle closing below the BBKPL. And we have our pop-up alert here for the 9:30 a.m. candle closing below the BBKPL. So that is our bearish signal for the 9:30 a.m. opening candle trade. So trade number one is a bearish trade off the BBKPL. The tight stop loss on this trade is the QL above the BBKPL, or if using the standard stop loss, which is the recommended stop loss to use over the tight one, then it is the first midpoint level above, and this is the standard stop loss on this trade. The 9:42 a.m. candle here, either one of these stop losses was taken out here, including the standard stop loss. So on the 9:42 a.m. candle, we have a stop out here. So this is a loss on this opening trade. Initially, it did dip down in our favor. However, it did reverse here. And unfortunately, did get a stop out and a loss on this opening trade here. However, after stalling out at the pre-market high here of 67.2869, it did move back down. And after touching the BBKPL here and having this brief move back up, it did slam down through it again. And so we have bearish trade number two on this close below the BBKPL level here. So bearish trade number two is again a bearish trade off the BBKPL. Same stop losses apply here, either using the tight stop loss, which is the QL above, or the standard stop loss, which is the recommended one, is the first midpoint level above. In this particular case, price continued trending downward from this bearish trade number two entry. Neither stop loss was hit. And here we have on this particular 10:16 a.m. candle here, the scalp only exit if you're just doing a scalp only trade, which is a one level move in your favor. One level being one full level in our favor from the level the trade was taken off of, the BBKPL, to the next main key level, which is the S1 level. However, if doing a regular trade, then and this candle here on the 10:46 a.m. candle, the 1.5 level move, which is the minimum threshold for a regular trade, was met. If you were instead going by the ideal move for a regular trade, then that was the 2-level move, which was met here at 10:56 a.m. So depending on which one of these minimum threshold level moves that you were utilizing, either the 1.5 level or 2-level move, this is your trigger here on a regular trade to either start making adjustments to your stop loss or exiting the trade 100%, or in the case of trading multiple contracts, meaning 3 or more contracts, when the threshold is met on a regular trade, then you are instead exiting somewhere between 60 to 90% of your multiple contracts, and then you are adjusting your stop loss to break even or break even plus a profit buffer on the remaining runners. Then the idea with the remaining runners on a regular trade is at each succeeding move in your favor after the minimum threshold has been met, you are then either further adjusting your stop loss on your remaining runners, or you're doing a combination of exiting some of your remaining runners at each level move in your favor and further adjusting your stop loss on any remaining runners that you have not exited additionally. So here, as far as the sequence, we have the 1.5 level move threshold being met here at 10:46. Then on this candle here at 10:54, we have a combined hit of both the YDC, yesterday's daily close, and YDL, yesterday's daily low level. So that is your additional waypoint here. Then on the 10:56 a.m. candle, we have a 2-level move, which takes out the S2 level. So that's now a 2-level move in our favor. Then on this 11:42 a.m. candle here, we have a hit of the pre-market low level. So that is your additional waypoint here. And then finally on this candle here, 11:56, we have a hit of the mid S2, S3 level. That is now a 2.5 level move in your favor. Price continued sideways throughout most of the rest of the session, and then finally slamming down through mid S2, S3 here at 146 before trying to move back above the PML, but ending the day much lower, getting close to the S3 level, and then closing here at 4 p.m. close to the 66.32.17 here to end the day finally being about 80 points lower from the bull bear KPL level. So next we're going to take a look at the actual entry prices and then all of the prices at the different levels here, the scalp only exit, and then also the regular trade minimum thresholds being met, and then also the additional waypoints. Okay, so for those of you who might be wondering, well, how is this working for people that have purchased the daily key levels indicators? You can go to daytradinggps.com and look at the user reviews and feedback. We've just taken some of them here and highlighted parts of them, but we invite you to go to daytradinggps.com and look at the reviews and trader feedback on our various daily key levels indicators, including the SPX daily key levels indicator. Thank you. Okay, so now we'll run through the two trades for this session. Both again were bearish trades off the BBKPL level. We have bearish trade number one, that's the 9:30 a.m. opening candle closing below the bull bear KPL. We're on a 2-minute chart, that's the recommended chart time frame that you see in all of our SPX session videos for utilizing the daily key level strategy with this indicator. So we have our 9:30 a.m. BBKPL opening candle alert here, alerting us to the candle close below the BBKPL, and it's within the acceptable range, which is why the alert shows up. If it was outside of the acceptable range, then you would see no alert here. Okay, so we have this trade here. We have, again, the standard stop loss in this trade, which is the recommended stop loss to use. is the first midpoint level above. If you instead want to use the tight stop loss, it's the QL level above, and these stop loss levels are above the level since this is a bearish trade. If it was a bullish trade instead, they would be, the tight stop loss would be the QL level below, and the standard stop loss would be the midpoint level below. As far as option strikes, there's always going to be 3 option strikes you can consider on any bullish or bearish trade from any main key level with this indicator. The standard play is going to be the strike closest to the price of the level you're basing the trade off of. So in this case, the bull bear KPL 67.1478 is going to be the 67.15 strike. In this case, a put option strike since this is a bearish play. 9:30 a.m. opening candle ask price on the close $27. The 2 out of the money OTM strikes you can consider on this trade. How you figure that out with this indicator is you look in the direction of the trade. You go to the first midpoint level below, since this is a bearish trade. That is mid BBKPL S1 67.0275. The closest strike to that is the 67.05 strike. The 67.05 put option, the ask price of the 9:30 a.m. candle close is $22.40. The furthest out of the money one you can consider on this trade is going to be the strike closest to one full level below, where again we're looking below since it's a bearish trade. The S1 66.9072. Closest strike to that is the 66.90. Excuse my typo here. The 66.90 put option, the ask price on the 9:30 a.m. candle close, $16.70. Now, in this particular trade, either one of these stop losses were stopped out here on this 9:42 a.m. candle. So we have a stop out. We're always using the standard stop loss. That is the recommended stop loss. Obviously, if you use the tight stop loss, the loss will be less on this trade than the standard. On this one, the 67.15 put was stopped out at 16.60. So that is the low price of the 9:42 a.m. candle. So we're going by the worst case scenario that's possible within this stop out candle, which is this one here. So as you can see, it does hit both the standard stop loss and the tight stop loss in this particular candle. The 67.05, the lowest price of this candle, $13.40, loss of $900. 66.90, furthest out of the money, lowest price in this candle, $9.60. That's a loss of $710. As we stated in the beginning of the video, we have bearish trade number 2 here. After price topped out at the PMH, began its descent back below, closed below the bull bear KPL again here on the decisive close below. Again, same stop losses used since this is the same level and the same trade, a bearish trade off of the bull bear KPL. It's the same stop losses that you have, either tight stop loss here on the QL above or the standard stop loss in the first midpoint above. So it's the same exact trade, just happening at on this candle later on in the session. Standard play, everything's going to be the same since it's taken off the same level, same bearish trade. Everything is the same. So the standard play, closest strike to 67.1478, 67.15, put option, midpoint level 67.0275. So again, 67.05 put option, S1 level 66.90.72. So that's going to be the 66.90 put option. So again, same exact trade, just taking place later on in the session. So here we have the 10:02 a.m. candles. This is the 10:02 a.m. candle closing at 10:04. And we have the ask prices 25.80 on the 67.15, 21.20 on the 67.05, and 15.6 is the ask price on the close on the furthest out of the money 66.90. Again, excuse my typo here. Okay, so here we have the 10:16 a.m. candle, the S1 hit. If doing only a scalp only trade, this would be your exit for all contracts on a scalp only. We have all the data boxes here progressing through the session. So in the 10:16, we have the bid price of $37.10 on the 67.15. So if only doing a scalp, your profit here is $1,130. On the 67.05, the bid is 31. That's a profit of $980. On the furthest out of the money, 66.90, the bid on the candle close $23.40. That's a profit of $780. 10:46 a.m. we have a hit of the mid S1 S2 hit. That's now a 1.5 level move in your favor. So if doing a regular trade, the 1.5 level move in your favor, as you've seen in our other videos, is the minimum required threshold for triggering all the different options that you have when doing a regular day trade as opposed to a scalp. On scalps, you're just doing the quick in and out of a one level move in your favor. Then you would be out of this trade and then you'd be looking for the next trade opportunity. However, we're doing a regular trade, just pointing out the differences between the scalp and the regular trade. The regular trade is a 1.5 level move minimum threshold in your favor, or a 2 level minimum ideal move in your favor for triggering the different options that you have with a regular trade. A regular trade differs in the fact that once you meet the minimum required threshold, you then have several options as to how to handle your trade from that point on. One of which is just exiting 100% of your contracts at that level, either the 1.5 or 2 level move. So that is option number one that you have under regular trade. Option number two under regular trade is to adjust your stop loss on all of your contracts to break even. So again, what that means is you're not, even though you started out with the initial stop loss based on a level, now with the regular trade, when you're adjusting your stop loss to break even, you are then changing to a price-based stop loss, and you're changing your stop loss to the price you paid for the option. So the second option is just adjusting your stop loss, not exiting any contracts, but adjusting your stop loss to break even, the price you paid. The next alternative under that second option is to instead change the stop loss not only to break even, but to add an initial profit buffer, which would be somewhere between 10% to 15%. That is, of course, up to each individual trader. However, recommended that you at least do 10%. If you do too much here, you run the risk of, on a whipsaw back up, of getting stopped out on everything. So if you're going to add a profit buffer, if you added something like 25, 30, 40, 50%, something like that, then you run the risk of you've added too much of a profit buffer. You're not giving the trade enough room to breathe. Obviously, the most room to breathe is just changing it to break even. But if you're going to add a profit buffer, it should be a minimal profit buffer of, say, 10% up to 15% at the most. Of course, you could go less than 10%. That's up to the trader. If you want to do 5%, just to have something, that of course you could do as well. So that would be another option. The third option on regular trades only applies if you're doing multiple options, and what multiple options means under a regular trade is 3 or more options. So the last option under a regular trade is you're basically looking to exit the majority of your contracts majority meaning 60 to 90% of your contracts. Of course, that would depend on how many contracts you're trading, whether you can do 60 up to 90. Then on what you're trying to do at that point is you're exiting. So you're exiting the majority of your contracts to lock in profits and close those out. And then on the remaining runners that you have left, you want to de-risk them by moving the stop loss to either break even or break even plus the minimal profit buffer like we talked about. And then the idea with the remaining runners is as price continues to move in your favor, at each decision waypoint level move in your favor after this minimum threshold has been met, then with the de-risked runners that you have remaining, at each continuing level move in your favor, you either exit some of your remaining runners and adjust the stop loss on whatever runners are left, or you can simply let the remaining runners ride as price continues to move in your favor until you want to decide when to exit all the remaining runners, or you simply, as stated before, you would, depending on how many runners you have left, you would exit some of your remaining runners at each level move in your favor, and then continue to adjust the stop loss further on any remaining runners until finally, when price has moved further enough in your favor to an important key level, you can exit all the remaining runners. So the idea is to capture profits on the majority of your contracts, 60 to 90, and then de-risk remaining runners to capture larger profits should the move continue in your favor, because you do not know how much further this move may go. It may go 3, 4, 5 levels or greater in your favor. It just depends on what's happening in the session, any news that may come out, any overall institutional sentiment that might start accelerating to whatever side that you're on. It could be on the bearish side. If they decide to take the market down quite a bit, then you want to still be in the trade with a de-risked runner to capture the majority of that move down. And of course, if this was a bullish trade instead, it would be the opposite on capturing more of a move on the way up. Okay, so we have the minimum threshold move here. The bid prices, this is the 10:46 a.m. candle here. So we go up to the 10:46 data boxes here, look for the bid prices on these candle closes. 67.15 put is now 47 excuse me, 47.30 on the bid on the candle close. That is now a profit of $2,150. Remember, we did have this loss here to begin with, so the net result is you're taking this profit here and subtracting the loss for whatever put option that you entered, either at the money or one of the two out of the monies. 67.05, $40.10 bid on the candle close, profit $1,890. Again, all of these figures are per option. So if you're trading just one option, then it's pretty clean cut. If you're trading multiple options, then you have to multiply these by the amount of options that you had. 66.90, $30.80 bid on the candle close, profit $1,520. Now on the 10:54 a.m. candle handle, just a few candles later, we have a hit of both the YDC and YDL level here. So these are very important here. This is yesterday's daily close and yesterday's daily open. So if price continues through to fall below this and start closing below this, as you can see here, it did start doing that, then it tried an attempt to go back up and stay above it, which it failed. When you see something like this where both of these are very close to each other, then that magnifies the effect of how important these levels are versus just being a singular level here. So you have both yesterday's daily close and yesterday's daily low here very close to each other. So a price is not able to sustain going back above this and reversing, then you're looking for a major move below this if price is unable to hold above these two. Okay, so at this point though, as talked about before, since this is occurring after the minimum 1.5 level threshold here, you have these levels occurring below that, so that's another decision waypoint for a regular trade. This 67.15 put, remember we're on the 10:54 a.m. candle here, so we're looking at these boxes. The bid price 49.80 on the candle close on the 67.15. So now the profit is 2,400. The 67.05 is 42.20. That's a profit of 2,100 on that. 66.90 now 32.10 bid on the candle close. So that is a profit of 16.50 on that one. Now here at the 10:56 a.m. candle, we have a hit of the S2 level. That is now a 2-level move in your favor. That is considered the minimum ideal move threshold for a regular trade as opposed to the absolute minimum 1.5 level move. The 67.15 put is now 57.20 bid on the candle close. We're looking at the 10:56 a.m., which is this row here. 57.20 bid on this candle close. Profit now $3,140. 67.05, 49.20 on the bid on the candle close. Profit $2,800 per option. 66.90, 38.30 bid on the candle close. Profit now $2,270 per option. Now after price slices through here, it does come back up and attempt to go back above S2 and these two levels here. However, it fails just a few candles later and starts continuing its descent again. So here, the logical next point here, price is seeking out is the pre-market low, 66.4407. It hits that at 11:42 a.m. PML hit here on this candle. We go to the 11:42 a.m. Data boxes here, in which we have the bids here on the close of the candle here. 72.30 on the 67.15. Profit now 46.50. Profit per option 67.05 on the 11:42. 63.10. Profit $4,190. 66.90 now $50 in the bid. Profit $3,440 per option. Now, as you can see here, we have the mid S2, S3 level. That's another waypoint here. It's just below this level here of the PML. So it's very logical to consider this would be another point here that's very important since it's in confluence with this PML. It kind of doubles the importance here. And as you can see here, by price action here, that the price was just bouncing, hitting this and bouncing it off several times. So again, it's very important if it breaks through this level and starts sustaining below it. So as you can see, it's treating both of these as it should because of the confluence between these two as price continued to go back down, test, bounce off, go back down, test, bounce off. Here it went back down, closed below, went back up to both of them, tried to go above, and then at the end of the day, giving the sentiment of what's happening now with the war in the Middle East and everything and all the uncertainty, price just basically gave way at the end of the day. Traders not really wanting to hold positions long into this weekend session because they don't know what's going to happen with the war and the price of oil, how oil may spike again on Sunday evening if there's no resolution to this war and there is continued uncertainty with the Strait of Hormuz and the oil flow through that. So if you were holding position a final runner into the close, then we also look at these closing candles here on the 4 p.m. candle. But here we have the hit of the mid S2, S3 level here. If you're wanting to basically be done for the session here, we have price moving all the way down to PML in this level here. If you're still holding any remaining runners, then it would just be a good choice just to leave just one remaining runner if you're going to leave anything, and to further adjust the stop loss in case we have a move back up to S2, and that would again with these two levels being close to S2, you'd want to protect your stop loss price on any remaining runners to reflect it just being taken out right here if you're going to leave a remaining runner versus just letting it run through the rest of the session. Okay, so at the 11:56 a.m. Candle here, we have the hit of the mid S2, S3 level. 11:56 a.m. data boxes here, 67.15, put now 74.10, bid on the candle close, profit $4,830. 67.05, 64.90, profit $4,370 per option. 66.90 now $52, profit $3,640 per option. Now, if holding any remaining runners to the end of the session, which is one thing you can do with SPX options because they differ from SPY options in the fact that if you hold them through the close, then you're just paid the difference between the strike price of your option and what the closing final settlement price is, which is typically going to be the same as the 3:58 to 4 p.m. candle close. As in some sessions here or there, maybe a couple sessions a year, there might be a slight difference in the actual settlement between that and what that 3:58 to 4 p.m. close is. However, in about 99.9% of the time, usually that settlement is exactly the same. Nevertheless, we're just going to go by the bid prices on this candle close here. If holding any final runners, we'll just go on the bid. If you're not just going to just hold through the end and just get that settlement difference. So the 67.15 is $82. That's $5,620 profit. The 67.05 is $72. Profit $5,080 per option. 66.90, $57. Profit $4,140 per option. Now we're just going to go off the prices here on this clip of the mid S2, S3, which is happening at 11:56. So we have a profit of $4,830 here. We have a profit of $4,830 here, and we have a loss here of $1,040. Okay, so with the 48.30 minus the 1,040, that is a net of $37.90 before any commissions that you may pay. If you're with a broker that charges commissions, then you need to subtract that. If you're with a broker that does not, then you'd just be looking at any slippage and CBOE exchange clearing fees, which are usually pretty minimal. These 67.05, 43.70, but we have a loss of 900 here, so that is a net of $3,470 per option on that one. The 66.90, 36.40 minus this loss here on the opening trade of 710, that is a net of $2,930 per option. Of course, that's before commissions, clearing fees, and any slippage. course, the figures would be slightly higher here on the closing candle if you held any remaining runners into the close here. However, given that this is PML and mid S2, S3 here, is typically a good idea to exit all remaining ones here. But if you're going to hold any remaining runner at all, then you would adjust your profit buffer and your stop loss to account for this area here. So in case that would be the magnet of going back up here as a possibility. So you would not want to have it to where it would be in jeopardy if it went above this. So this would be the minimum that you would want to make sure that if you're setting a profit buffer on any remaining runners, that you're accounting for this area here. Okay, so that's going to do it for today's session. Like as pointed out in the opening of the video, if you would like to know more about how this indicator works and get more full details on what all the different levels mean and how the indicator works in general, then just look at the links in the description of this video, which will have both a Google Drive link to a document that will have different videos on different specific topics concerning this indicator, excuse me. And then also there is a link there to a video overview of the V 2.0 version of this indicator, which will give you the basic framework of how everything works. Then there's also a link to a video on all the features that were added in the V 3.0 version of this indicator. And then there's also some longer session videos in which we go into full detail about the daily key level strategy and all the different aspects of the daily key level strategy. There's also one video link which also goes into our lotto options optional strategy, which is for end of day between the 2 p.m. to 3:45 p.m. Entry window for lotto option trades. And then there's a couple of additional session videos as well under that. Now, for those of you who are interested in purchasing this indicator, you can email us at daytradinggps@gmail.com to request a discount promo code on the purchase of this indicator for the purchase of lifetime access on the indicator. If you did like today's video, I'd appreciate it if you would hit the like button, as that helps us with the YouTube algorithm and helps support the channel. And also, if you'd like to hit the subscribe button, then you can be notified of any additional videos that we do, not only on SPX, but on our other daily key levels indicators, which we have for stocks and ETFs, futures and Forex CFDs, Forex currency pairs and cryptocurrencies. And then we also have a daily key levels indicator for the NASDAQ index as well, for those that prefer to trade NASDAQ index over the SPX index. Okay, so that's going to wrap it up for today's video, and we appreciate you taking the time to watch today's video and support our channel, and we wish you much prosperity in all your future trading.